So, you want to own a coffee cafe. Most people think owning one means quitting a desk job to pull espresso shots for regulars, selling a little charm along with the caffeine, and watching a cozy little shop slowly turn into a neighborhood institution. That part is roughly true. Except before any of that, you need to understand something the coffee industry almost never tells aspiring owners. According to IBISWorld's 2026 industry report, the sector just posted 0.2% revenue growth on a $75.5 billion base, and average revenue per shop is only growing about 1.3% a year. You are not entering a boom, you are entering a mature, brutally efficient market where the operators who win are not the ones with the best beans. They are the ones who understood the spreadsheet before they understood the espresso machine. Startup costs. Here is where your money actually goes. According to BrewSpace's 2026 Startup Cost Calculator, opening a full-service cafe in the United States typically runs $150,000 to $400,000, while a smaller espresso bar or kiosk can launch for $50,000 to $100,000. Break it down further and the picture gets specific fast. Equipment, your espresso machine, grinders, brewers, refrigeration, will run you $15,000 to $50,000, depending on whether you buy new or refurbished, per Foundra's 2026 cost breakdown. Leasehold improvements, meaning the actual build-out of plumbing, electrical, and ventilation for a commercial kitchen space, run $20,000 to $150,000, and build-out costs alone can hit $150 to $300 per square foot, according to Corona POS's 2026 guide. Licensing and permits are comparatively small, usually $2,000 to $5,000. Initial inventory, meaning your first batch of beans, milk, syrups, cups, and pastries, adds another $5,000 to $10,000. And then there's the line item that actually kills most first-time owners: working capital. You need 3 to 6 months of operating cash before the shop is reliably cash flow positive, and Bellwether Coffee pegs that reserve at $20,000 to $100,000 on its own. Add it all up, and the realistic all-in range, per My Coffee Explorer's 2026 analysis, is $150,000 to $250,000 for a standard 800 to 1,200 square foot independent cafe, plus another $60,000 to $100,000 in reserve. That number is not a rounding error. That number is the actual price of admission. So the question becomes obvious. Why would anyone put $200,000 into a business with net margins that industry analysts consistently place at just 2.5 to 6.5%? Here's the part that catches almost every first-time owner off guard. The coffee cafe business is not actually a margin business. It's a throughput in mix business. Your core product, a cup of drip coffee, carries a gross margin north of 85% because your input cost is a few cents of beans and water against a $3 to $5 price point. Espresso drinks, where you're adding milk and syrup, still run gross margins around 65 to 75%, according to Gitnux's 2026 coffee shop statistics report. The real leverage comes from what you sell alongside the coffee. A pastry with a $1.20 food cost sold at $4.50 is a margin machine. Bottled retail beans, branded merchandise, loyalty app prepayment, every one of those stacks high-margin revenue on top of a labor and rent structure that barely changes whether you sell 200 cups a day or 350. This is operating leverage in its purest form. Your rent is fixed, your base staffing is largely fixed, so every additional transaction past your break-even point drops disproportionately to the bottom line. That's why a shop doing $700,000 a year can be dramatically more profitable per dollar of revenue than one doing $400,000, even though the cost structure looks nearly identical on paper. The cafes that survive are not selling coffee, they're selling transactions and stacking margin on top of every single one. Failure stats and why businesses fail. Now for the sobering part. A widely cited claim floating around coffee business content puts first-year failure at 73%, but that figure traces back to a single self-promotional blog post from an owner selling consulting calls, and it's considered an overstatement by most analysts who track the sector. The more defensible numbers come from Dripos, which has 2025 data on shops using point-of-sale software, found that roughly 60% of new coffee shops survive past year one, with about half still operating at the 5-year mark. A separate survey of 232 independent coffee shop owners, cited by Bean and Brewtech, found failure rates of 50 to 74% over 5 years, and even that range comes with wide disagreement among the owners surveyed themselves. IBISWorld's broader restaurant data, by contrast, puts first-year restaurant failure closer to 30%. Whichever number you trust, the pattern behind the failures is consistent across every source. First, undercapitalization. Owners budget for the build-out in equipment, but not for the six-figure cash reserve needed to survive the 18 to 36 months it typically takes to break even, per My Coffee Explorer's 2026 data. Second, location miscalculation. Rent that looked affordable on a pro forma becomes unsustainable once foot traffic underperforms projections. Third, labor cost creep, which industry data places at around 32% of total expenses, and climbing as minimum wages rise across major markets. Fourth, weak inventory discipline. Untracked pour cost and waste quietly erode a margin that was already thin. And fifth, a fatal over-reliance on opening weekend enthusiasm, when friends and social media followers show up for the launch and then traffic craters by week 3, leaving owners with a revenue picture that never matches their original plan. Layer onto that the newer pressure most 2020-era business plans never modeled. Coffee bean input costs have climbed sharply over the past 2 years, and IBISWorld's own 2026 outlook explicitly flags rising commodity prices as the reason industry-wide profit is expected to compress even as revenue inches up. A shop that priced its menu against 2023 wholesale bean costs is now operating on a margin that quietly eroded underneath it, and owners who aren't pre-pricing quarterly are absorbing that squeeze directly out of take-home profit. So let's run the actual numbers on 2 realistic versions of your coffee cafe. Option 1, the small, lean boutique version, a single 900-square-foot location, startup cost around $180,000, serving roughly 200 transactions a day at an average ticket of $6.50. That produces daily revenue of about $1,300, or roughly $475,000 annually. Cost of goods sold at 28% takes $133,000. Labor at 30% of revenue takes $142,500. Rent and occupancy costs typically run 8 to 10% of revenue in a well-negotiated lease, so call it $42,750. Utilities, insurance, POS fees, marketing, and general operating costs eat another 18%, roughly $85,500. That leaves an operating profit before debt service of approximately $71,250, and after paying down startup financing, a realistic net annual profit in the $35,000 to $50,000 range in year 2 or 3 once the shop has stabilized past the break-even runway. Option 2, the scaled, aggressive version. 2 locations, 1 flagship with a drive-through component, total startup investment around $520,000, combined daily transactions of 550 at a slightly higher average ticket of $7.25. That produces combined annual revenue near $1.45 million. With economies of scale on purchasing and shared management overhead, COGS drops to 26%, labor holds at 29% due to cross-location scheduling efficiency, occupancy runs 9%, and operating expenses fall to 15% of revenue thanks to shared marketing and back-office costs. That leaves an operating profit before debt service of approximately $304,500, and after financing costs, a realistic net annual profit in the $180,000 to $230,000 range. The best-performing multi-unit independent operators, the ones with strong drive-through throughput and loyalty app repeat rates above 60%, can push net margins toward the 12 to 15% ceiling that Dutch Bros and other scaled operators report in their public filings, which on $1.45 million in revenue means a theoretical best-case ceiling north of $200,000, achievable only by the operators who treat throughput and repeat visitation as the entire business, not a side effect of good coffee. So here's the real shape of it, an industry growing at 0.2% a year with net margins thinner than almost any other retail category, still produces owners clearing 6 figures, not because the coffee is exceptional, but because the operating leverage on a fixed cost, high transaction, high margin add-on model is one of the most forgiving structures in small business for the operators disciplined enough to actually run the numbers instead of chasing the aesthetic. Not bad for an industry most people still picture as 2 guys, a chalkboard, and a dream. If you found this video interesting, please like and subscribe.